Hello everyone, welcome back. Welcome back to the chat room. My name is Ed Ponzi and it's great to be here with you today. I'm speaking to you on a Thursday night. It's non-farm payroll coming on Friday morning. Market is kind of crazy right now. And if you look at this, I'm showing you the S&P 500 today. Just try to drink that in. Today was the last day of July. We spent the entire month of July getting very close to 2000. There's 1980, right? So we're getting very close to 2000, but we just couldn't get there. I'm going to show you something that I noticed last night that I find very interesting. You look at this particular day right here, which was an all-time high. Oops, there it is. That green candle. This was an all-time high at the time, July 3rd. Closing high, 1985, 1985.44. That's about 14.5 points away from 2000, which is a huge round number on the S&P 500. And this should affect currencies too. So I'm going to pull up the ATR. Check this out. So I said 14.5 points away, right? We'll put up the ATR. At that time, the ATR was, the ATR was down here. ATR was pretty low. It was actually under 12. Let's keep looking. As we go through July, I spy a couple of dojis right here. The high, so we came within 14.5 points of 2000. Then on 7/23, July 23rd, we close at 1987.01. We come within 13 points. And on 7/24, we close at 1987.98. We come within 12 points. So 14, 13, 12 points away, and each time it backs off. Now, at that time, especially on that last one, your ATR at that time, 13.84, and we came within 13 points of 2000. The day before that, 7/23, we came within 13 points of 2000. The ATR was 14. And back here on July 3rd, we came within 15 points of 2000, and the ATR there was 11. So it seems to me that when this market gets within one ATR, think of an ATR. One ATR is 1 day's journey. One average day's journey is about 13 or so points. Every time we get about 13 or so points away from 2000, this market turns chicken and runs. And this is telling me, look, as far as my stock people are concerned, I'm not buying any stocks until this thing breaks 2000. We've been trimming during, go check our last session. Boy, I tell you, am I ever glad I got rid of CBI. Did that hurt a little bit to take a loss on that? My average, I bought at 60, I bought at 70. And I bought at 65. My average entry was 67.50. I got out at 63.50. I lost $4 a share. Do you think that hurt? Not as much as staying in would have hurt, because I got out, my average get out was 65.5. It's at 59 now. Okay, we got out of Starbucks. You think I'm glad I got out of Starbucks with a 4-point gain? If I sold it today, I would have a 2-point gain. Okay, and I might not be done yet because there's another one I'm thinking of letting go as Wells Fargo. We'll take a look. I haven't let this one go yet, but I'm down a few bucks on this one. But I'm really not liking this market now because when I see a move like we saw, we're down like a buck or two on this one. It's no biggie. But when I see this type of move, that's the type of move that changes the whole polarity of the market. Now, we didn't look at the volume yet, so I'm going to show you the volume here on TradeStation. You can see this was the highest. Not only was it the worst day we've seen in months on the index, but the volume was above average. Average volume, right, is here, 1765154. Instead, we get 2442, 232. That means to me we're not quite 50% above the average volume, but it is the highest volume day that we've had, I think, since way back in April. So, and that's kind of impressive. You know why it's impressive to have a high volume day? Your highest volume day in months on July 31st when no one's around. Just imagine if we hadn't been in the middle of summer, what would the volume have looked like? Okay, so the thing about this rally that really fell apart too that I have to mention to you is when we were hitting these new highs back here, the number of stocks that were participating was very low. Like right here where the S&P 500 is hitting its high point, the NASDAQ was also hitting its highest point in years, but less than 2% of the stocks on the NASDAQ were hitting new highs. And you're thinking, well, how is it possible that the index can hit new highs, but most of the stocks in the index, the vast majority of them, are not? Well, because they're not equally weighted. The stocks, the very large cap stocks, are given a greater weighting on the NASDAQ, and some of the largest cap stocks, there's just a handful of them that are doing well. Apple's still doing pretty well. Microsoft is still doing, it's still coming back, but 43, it's still way better than it was, if you look at it like that, right? It's way better than it was. Go back to Apple. Apple still looks pretty good when you look at it that way, right? What else? Cisco. Close to its highs for the year. So some of the biggest names out there are really a handful of big names are supporting this market. It's a very thin rally. You know, you want to see a lot of stocks across a lot of sectors holding it up, but it's what we call a hollow rally. It's really it's not as strong as it appears because it's just a handful of large caps holding it up. So you might be saying, well, what about that blowout GDP number that we had yesterday? Didn't we just have a kick-butt GDP number? Yeah, we were up 4% on GDP, but I like to point this out, and this is directly from the Bureau of Labor Statistics. The change in real private inventories added 1.66 percentage points to second quarter GDP. 1.66 percentage points. So if it's up 4%, but 1.66 of that is nonsense. So 4 minus 1.66, your GDP is up 2.33, which is better than down, but it's not that great. Okay, can't get too excited about that. So maybe that number was not as good as it appeared. Speaking of numbers, how many of you noticed this one today? This one really sent off a shockwave because sometimes we see numbers that miss by a little, but look at this PMI number. Expecting 63.2 on Chicago PMI, and instead we get 52.6. This is not the type of number that normally produces big misses like that. This is not a volatile statistic. It shouldn't miss by that much. And it really screams that, okay, yesterday's GDP wasn't as good as it appeared. Chicago PMI, way, way off the mark. It could just be an outlier. We hope so. But I think that freaked a lot of people out. I think that scared a lot of people out. And then you add to the fact that it's a very hollow rally, and the S&P 500 just simply does not want to cross 2,000. We are not buying any more stocks. Now, so am I glad that we let some of the things go that we did? Absolutely yes. And as I said, we're probably going to let go of Wells Fargo as well. We are still holding Apple, which is doing very well. Dean Foods, which is not, but it's it's like I said, that's a different scenario. And we are still long JCPenney, which is not getting hurt at all in this mess. JCPenney is not suffering any ill. I see green candles. Okay. ACT, we bought at 15 on 215. It's at 214. No big deal. This is hanging in. So we're okay. Oh, and don't forget our shorts. Lulu, right? Nice red candle on our short position on Lulu. That's always good to see. And we're also short TJ Maxx. Can't believe it was up today, but chart still looks horrible if you look at it like that, right? So the only thing that got me thinking, I was wondering if I should reshort Target. This thing looks like it climbed the mountain but failed to make a higher high, and big dump today on high volume. They named a new CEO finally, but it may be too late for them. So I'm actually thinking of reshorting this. I'm not going to be entering any new longs. Right now we have two shorts, okay, TJ Maxx and we have Lulu. We have 1, 2, 3, 5 longs and 2 shorts. Expect that to very soon. We'll be saying goodbye to Wells Fargo. Expect that to be 4 longs and maybe 3 shorts. We're going to probably get to 50-50 very soon. I see no reason to buy stocks right now. You got to add to all of this that at the Fed meeting this week, we have reduced quantitative easing all the way from $85 billion a month to $25 billion a month. In addition to that, we had dissent. We've got people on the Federal Open Market Committee. That's the board inside the Fed. We've got people in the FOMC saying we want to raise interest rates, right? Charles Plosser of the Philly Fed, he wants to raise interest rates. So party's coming to an end, I think, on the stock market. It's hard to fight the Fed. When interest rates start going up, stocks are probably going to start going down. There's not much else you can say about it. TLT, well, I'll tell you what, bonds have been selling off pretty heavy the last 2 days. Look at the volume on TLT today. So this was hitting new highs earlier this week, and now it's coming down a bit. But truth be told, if the stock market gets really ugly, a lot of money could go into bonds. So what's wrong with that, right? If money goes into bonds, this will go higher. GLD, gold. Gold is not getting it done, man. This is the lowest it's been since I bought it, and it really has me thinking whether or not I should trim that as well. So maybe we'll be getting out of gold, maybe we'll be GLD, maybe we'll be getting out of Wells Fargo, WFC as early as Friday. I'll certainly notify via the Twitter feed. Okay, so anyway, that's it for the stock world. What about the world of Forex? Well, the crazy thing about this, right, look at that huge candle. Now, there's no way that you get a huge candle like that and say that that's not going to affect currencies. It doesn't even make sense. It's got to affect currencies, right? Well, no, it doesn't have to affect currencies at all, apparently. But we did hit target 1 earlier this week. So our entry initially, it was 134.65. Our first target was 134.15, the stop. So we have closed 1/3 of the trade, and the stop now comes down to 134.65. You'll see the green line and the red line together. We'll try to put them together. All right, but you get the idea. So I love this position that we're in right now because we've put 50 pips in our pocket, right? We've put 50 pips in our pocket. The stop's at break even. So the worst case scenario is we make 50 pips on 1/3 of the trade and break even on 2/3 of the trade. That's not a bad, it's a small win right now as far as I'm concerned. And it could become a larger win. Our second target is 133.05. I'm currently showing 133.88, so we're 83 pips away from the next target. And hopefully the euro continues to fall here. Euro is under pressure. A lot of the sanctions that are going from Europe to Russia are going to come back and hurt the European economy. If you shut Russia out of your capital markets, that means your capital markets are going to lose a very big customer, and that's part of the deal here. Bond yields are also very low, much lower in Europe than they are in the United States, and that's very strange. But it also attracts less money. You know, if your bonds are only yielding half, you know, if I think a German 10-year bond is yielding something like 1.25%, how are you going to attract flows of capital into your country if your bonds have such low yields, right? And this is definitely hurting the euro. That's great, though. I mean, we're short and we're loving it. Okay. Now, let's get to, we've got a question in. Do please continue to send your questions in to info@edponzi.com. Good day, Ed. On 7/14, you said you were watching cable and that 169.75 looks like a good entry point. Well, I did think so at the time, and that's where the line is. But you can see what happened is that it broke right through there, and it broke through the trend line, so I no longer think highly of this, obviously. Now, did I enter this trade? No, I couldn't, because I am already long the British pound against the yen, and right now we're up 7 pips on that trade. So, you know, we've been up, we've been down, but really it hasn't gone anywhere. But we do collect a little bit of interest every day on the guppy, GBP, JPY, right? The guppy. So, and that one maintained its trend line. Look at the difference. Guppy maintained the trend line. Cable broke its trend line. So I'm not so fond of cable anymore on the long side. So anyway, back to the question. I got in at 169.54 on 7/29. It took almost 2 weeks before I was able to enter the trade. And you're probably wishing you hadn't right now, because if you got in at 169.54 and I'm showing 168.82, you know, I'm not sure where you put your stop, but that's, you know, you're either stopped out or you're down about 70 pips on that. So look, trades don't always work out, gang. When they don't, just don't let them come back to haunt you, right? Don't hang on to this thing thinking, oh, it'll come back, because you never know. Maybe it won't. And once you find yourself clinging to hope, that's when you know you got to close them out. You got to close them out. So anyway, my question was, 2 weeks too long to enter the trade? No. Was there an expiration date on when you were waiting for the price to pull up? No. As long as this was intact, as long as this trend line was intact, I was pretty good with it. So, in other words, I wasn't worried about how much time it might take to enter. And the fact that it took so long to enter is really a reflection of low volatility right now. Volatility has been extremely low. Even as the stock market's been popping up in volatility, currency market remains very non-volatile. It just is what it is. I don't worry about that. I'm just saying that's the way the market is right now. So everything is taking longer to occur. But you know what? Things are occurring. We're doing well on euro, right? So it's not like nothing's happening out there. So no, it wasn't too long to enter, you know, but obviously it's not working out so great right now. Okay, so anyway, so yeah, it doesn't matter to me how long that takes to get going. As long as the situation is still the same, as long as the price was above that trend line, I still liked it. Now not so much. It's broken that trend line. If I'm long, I'm getting out. You've got a lower low, broken trend line. I think it's time to say goodbye to that one. It says, this was using the 20 EMA as support. Let's put the 20 exponential moving average up there. 20 EMA, that's the 10. I'm going to make it the 20, and let's test that out. Has this been acting as support? Well, I don't really know about that. I mean, I wouldn't say that it's been acting as support. That's your 20 EMA right here, right? Look, watch the price just ignoring it, right through it, right through it, right through it. Little bit of support, but then ignore it, ignores it. Little bounce, ignores it, ignores it, ignores it. I'd say more often than not, this has not been working as support. On if you want to see one that looks really good, the channel, euro pound, right? The channel. This is what it looks like when bounce, 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 bounce. Pokes through today. Might have stopped our friend out. We have a friend who's kicking butt in this trade, a student in this class. Hopefully he didn't get stopped out today, but If he did get stopped out, he got stopped out with a huge profit, and that's the way you want to go. Okay, so that's what it looks like when it's working. To me, it's not working on this chart at all. It's really nothing like that, right? There's really no support there. Oh, I'm sorry. You were talking about the weekly. Jeez, weekly. Okay, 20-week acting as support. Yes, and you can see it corresponds fairly closely to that trend line. And today, does it come down and kiss that? Yes, yes. Today it comes down and kisses the 20 on the weekly. The low 16855. It looks like it just barely made it, and it just came within a few pips underneath that moving average. So if you're using that moving average, then forget about what I said. This is still legit. If your trade is based on the moving average, that's still a good trade. If it breaks through that moving average, though, you have to get out. That's the last straw if that breaks. Fair enough? Okay. I know you don't advocate the use of the 100 SMA, but it's consistently bouncing off of the 100 SMA on the daily. Let's pull that up. Moving average, one line, make it a 100. Right now I have the 200. This will come up in the color red. Whoop, not 1,000. 100-day moving average. It's bouncing off the 100-day and off the 20-week, which is surprising, right? Why is it bouncing off of the 100-day moving average at the same time that it's bouncing off of the 20-week moving average? How is that possible? Because there are 5 days in a week, and 5 times 20 is 100. Does that make sense? It's hitting the 100-day moving average and the 20-week moving average. Those two aren't very different because there are 5 days in a week. A 20-week moving average is not very different from a 100-day moving average. So they both came down and just barely kissed those averages. All right, so anyway, considering all the good news about the U.S. economy, why shouldn't I maintain my long with pound dollar? Well, forget about the U.S. economy. If you're trading it based on the 20-week moving average exponential, then you're still okay. And your stop should be somewhere underneath that 20-week moving average. I usually use a weekly ATR for that. Whoops. So, for example, ATR, average, true, range, boom. 151 is the ATR, so half of that would be approximately 75. My stop would be probably 75 pips under that moving average. Good luck. I hope it works out for you. By the way, someone in the UK is no friend of ours. When I say ours, I mean people like me and the person who wrote in this week. Why? Because we're both long the pound, me against the yen, this other gentleman against the dollar. But somebody on the Monetary Policy Committee today said that the pound was overvalued by 10%. That person's name is Broadbent. He's a member of the Monetary Policy Committee, which is part of the Bank of England, and he said that it was overvalued by 10%. So he did us no favors today. Okay, and as far as regarding the question, considering all the good news in the U.S. economy, why should I not maintain my long? I would just say this: the market and the economy are two different things. So don't let a rosy economic picture convince you to stay in a trade that might not really be that good. Let the technicals take you out. If you're going to get out, let the technicals take you out. If it breaks, if you're using that moving average, if you're leaning on it, if that's your original plan, then go ahead, lean on that moving average. But if that moving average breaks, and if it breaks by my read by about 75, I would get out. But that's just me. I'm not telling you what to do. It's not up to me. Okay. So where does that leave us? We're doing pretty good. on the euro. We're breaking even on the pound. I didn't talk about Euro Swiss. Euro Swiss started to grind a little bit higher. We've got a little bit here. Look at that nice candle today. We are now up 18 pips. Woohoo! Okay, we won't be throwing any parties just yet, but we are now 121.68. We bought at 121.50, so we're up 18 pips on this one. Hopefully it'll take off. Okay. And that's going to pretty much wrap it up. That pretty much covers everything. Hopefully everyone out there is going to be very careful during non-farm payrolls tomorrow. Just a little note, if for inexperienced traders, I'd be extremely careful about that. I would not trade this event. I would not be lured into trading this event. If you are an experienced trader, then use that experience to your advantage by not doing. Please don't do anything that's going to get you hurt. Don't chase after price. Understand that you might not get filled if you're clicking buttons. When that non-farm payroll is released, understand that you may be filled at very different prices than what you would have preferred. It happens, folks. The way I look at it is this. Imagine that it's your job to walk a tightrope, and one day every month the tightrope, the net underneath the tightrope is removed. You can still, if you wish, you can still walk on that tightrope with no net beneath you, if you wish. I choose not to. I mean, does non-farm payrolls change anything for me? I'm not closing any positions because, well, you see how I trade. I mean, my pound yen stop is 400 pips away. My euro Swiss stop is under 120. Okay, euro dollar, could this trade be messed up by non-farm payrolls? I guess it's possible, but I'm not worried about that. If it happens, it happens. I'm in. I'm short euro USD, and quite frankly, the moves that we get from non-farm, they're not quite as brutal as they used to be. Hopefully I won't regret having said that, but in general, I mean, we used to get 200 pip moves every non-farm payroll report, and those are now kind of rare. So anyway, be safe out there. Be careful. For a lot of folks, it might not be a bad idea to just take the day off, right? Don't enter any brand new trades right ahead of the number, and you'll probably, don't think about trying to make a lot of money. Think about how you might end up regretting it if you chase after that thing. Okay, gang, that's going to do it for today. I want to say thank you very much for listening. I appreciate your time and attention. It's an honor to speak to you folks and to hear from you, so I hope we will be hearing from you. Until next time, my name is Ed Ponzi. Thanks again so much for listening to me, and I'll speak to you again very, very soon. Everybody take care.